Hello, everybody. They say a picture's worth 1,000 words, so let's do some pictures here with respect to the retirement portfolios, in particular for the aggressive and the balanced portfolios. On the aggressive, I've got the historical returns up. You know, it started getting long in early 2012, and it's been pretty much that way all along, still that way. And here we are in 2015. So it's 3 years of up, 76% or so at this particular point in time. If we pop over, tighten this up a little bit, hopefully you can see that. Matter of fact, I'll bring it a little bit bigger and I'll just scroll it around. If we pop back over, right, these are the things we're in. We got a little bit safer. Oh, I think it was a couple months ago. Matter of fact, it was back here in January, so it was a couple months ago. Excuse me, February. And we moved over and got into the EZU, which is, provided decent returns. And the idea was to use, to take some profits in the two more risky categories and to move some of that money into overseas markets, in particular in this case Europe, because we thought it would do well, and we thought that it would probably do reasonably well. And these are not hedged for currency, but since we'd already had such a big hit in the euro, that it would probably do okay. Now, I still suspect this is going to bounce around, and that we're probably going to get another opportunity to buy this again. At the same time, if I look at where the equity markets are in the U.S., I'm becoming more and more concerned about what they're going to do. And as you can see here, we've got a big position in the SPY still compared to the other two, and I want to probably half that. Take that money out of here, put it into there, and wait to either put it here or to put it in the Asian markets. And what I'm looking at in particular is this. I never like to see swing points get nested together, grouped together, real tight, right together. And if we look at it on the daily, we've got the same thing up here on the daily time frame. We've also got compressed moves up after a big warning sign and kind of a shot across the bow back in October of last year. This market looks to me like it's slowly setting up to get a bigger hit to the downside. And right now, I don't know that we can take a big hit to the downside. We can certainly get back into this area, but I don't know that we're going to get back here quite yet. But there's no reason to wait around and to hope it doesn't happen, so to speak, especially if we can take that money and rotate it somewhere else where it's as safe or safer if the markets continue to go higher, and have it in a nice safe place in the meantime, either in the cash or the SHY in the meantime. And so it just seems to me like this is an opportune time. Take some more of that money, take it out of this, put it into this, or put it into cash itself. You can do it into either, and just wait it out. And we'll wait until we get a better opportunity to put some money back over here, or potentially in the EEMs. So that is the idea. That's what you're going to see me doing tomorrow. And so I'm bringing this to you to show you from this perspective what I'm thinking about doing. I also want to do the same thing in the balanced portfolio. So if I look over here, we've got a large position in the SPY, the QQQ, and the IWM, in particular in the Qs and the SPY. So what we want to do is take half of these off as well, rotate some of that money immediately into Europe, and then put the rest into a safer spot. And so again, you'll see me doing that based on exactly the same idea. Not trying to time these markets as much as, in terms of, small moves, as much as trying to time them in terms of a larger move. We may still be early here, but we're getting closer and closer to the point where the risk, given the structure of the market, the risks are starting to grow larger and larger. And let me show you just one more thought here to reinforce that. And that is, if I take the S&P 500 on a monthly, this October low that we hit, that low is going to print as a swing point low at the end of this month, end of April. it's going to be fairly close, in terms of a long-term time frame, fairly close to another swing point low back from February of the same year. That low, 1737, roughly 1738. This low, 1820. So I know that's a 100-point difference, but still, in terms of a long-term time frame, they're reasonably close. And when they start to get clustered like that, that becomes an issue. I don't know that I'm that worried about this big of a drop yet, and that's why I keep, as I say this, I'm talking about let's reallocate the monies into something else, not leave the market, not get quote-unquote safe yet, expecting some sort of a large decline, but instead using this as an opportunity to take some big gains off the table, put them elsewhere, right? Refocus our strategy a little bit after having made huge gains, refocus that strategy a little bit in some areas where we don't have quite the same amount of risk. So hopefully that gives you a feel for what we're doing here, what I'm going to do, and why I'm doing it, and you'll hopefully do the same. Do the same I'm doing. I'll leave it at that. You can always email me if you need, but that's what's happening. Thanks. Take care.